Holding companies, foundations, and trusts. That's something that we get asked quite a lot about what's right, what's wrong.
It is.
What's better, what's worse. And as with all these things, there's no right or wrong. There's no better or worse. It's all circumstantial.
Our job would be a lot easier if it was as
It
simple
would be.
as that.
Also, we wouldn't get paid though. It would be simple, right? So people would need us to do it. So, so that's something we get a lot. We're obviously working on quite a lot of that at the moment, helping families and business owners and whatnot all kind of structure a plan, and every single one is very different.
Yeah, so nuanced.
So why don't we get into the differences of what is a holding company, what is a trust, what is a foundation, kind of where they're used, and then we can get into some real life examples and actually kind of bring this thing to life, because I think that's the most valuable thing, right?
Exactly. That's what like
people
is the value. So yeah, I mean, they're all three completely different structures legally and fundamentally, right? Yeah. They all kind of are used in a similar setting and to achieve similar things, but on paper they're legally very different. The two biggest differences being a foundation versus a trust for me. And a trust is essentially just a legal arrangement. Like, I'm entrusting you to own, look after, and manage my assets on my behalf. Whereas a foundation and a holding company as well, they are independent and separate legal entities in of themselves.
Yeah. And actually, I got told, sorry, side note, but I actually got told like a brief history of trusts a few weeks ago. I didn't know this, but and I'll butcher the story, so I'll just summarize it. But basically, it was back in the day when like people would own, in the UK, for example, they'd own lots of land, and then they'd have to go away to fight at a war or whatever. It meant not a war, but like a battle of whatever. Yeah. And they would say to someone like, "Oh, can you look after my land while I'm not here?" And there was no paper trail for that. So they'd go away, battle away, come back and go, "Oh, hi, thanks very much. Can I have my land back?" And they'd be like, "No, what land?"
Oh, really?
Yeah. That's my land now.
Scammed by their neighbor.
Yeah. So then they started, I think it's Chancery Lane, is where they basically officially then started trusts.
Right.
In the UK, where it was, I'm going away and I'm entrusting this on you.
Yeah.
And when I get back, I have the right to take that back, effectively, to benefit from it. So, and you will be paid during the time you're looking after it. And then I'll come back and have it. So again, I probably butchered the story a little bit there, but it was quite fascinating. I didn't realize that it genuinely did start from, and it reminded me because you said, I'm entrusting you.
Yeah.
And it genuinely did start from, I trust you, you screwed me over. So now I've got to try and find some legal paperwork to make sure that can't happen again, which I thought was quite interesting.
That is very interesting. But there you go. You're not necessarily changing the legal ownership. You're just changing the legal holder or guardian of that asset, which then in turn changes the legal treatment of the asset from a tax point of view. And obviously the UK is where trust legislation was built, has developed, has the longest and most robust history. And trust, if you're in the UK, typically you default to using a trust.
Yeah.
If you're here in the UAE, you typically default to using a foundation because of the legal precedent and history of each of those vehicles.
So like here, you could probably set up a trust, but the legal framework doesn't.
Yeah, exactly.
Kind of cover
it's not been tried and tested.
Yeah, exactly. Yeah.
So, essentially, trust, like we say, it's you entrusting someone to manage and look after assets on your behalf. But there's three key players in the trust world. You've got the settler of the trust, who's the person who sets it up and obviously is the original owner of the assets. You've then got the trustee, who can be an independent person. It can be a private company. It can be a professional corporate trustee service, which is a regulated company that provides trustee services professionally for lots of different reasons and lots of different trusts and assets. And then you've got the beneficiaries as well.
Yeah.
And you can also be the settler and the beneficiary, which is 9 times out of 10 pretty common, and with other family members being the beneficiary. But you can also be your own trustee. But the problem with that is that it doesn't really offer any legal protection if there was an investigation, or if you were to get sued, or if the taxman were to come knocking. Really, if you're the trustee of your own trust and your own assets, the trust, for all intents and purposes, essentially dissolved in the eyes of the law.
Sorry.
So in the UK, in the US, you've got discretionary or revocable and irrevocable.
Yeah.
Which is discretionary and non-discretionary.
Effectively, yeah.
Yeah, should we talk about that?
Yeah.
Yeah. Do you want to talk about it? Should I?
You can.
Okay.
But let me just want to add on. I think with all these structures, the whole point of putting something in place is to mitigate against certain issues. Now, it might be tax, that might be succession planning, it might be wealth preservation, whatever it may be. Right? There's a reason for doing it, and if you end up putting yourself in all three seats of everything, you are kind of taking away a big chunk of the reason for doing it in the first place. So,
yeah, exactly.
Like you say, you could technically do it, but I think it would be very, very unwise to sit. And the other one we didn't just touch on was it's optional, but you can have a protector.
Yeah.
And the protector is there to make sure that the trustees do what they say they're supposed to do. And, the protector actually, and I've seen this firsthand with a client, is actually got a bigger role than a lot of people think. And they can actually, if you've got a protector in place, they're the only ones that can actually remove the trustees. The actual beneficiaries,
Yes.
or what have you, can't remove the trustees. So again, if you're going to put a protector in place, you need to make sure that person is, it might be an accountant, it might be a lawyer, it might be a wealth advisor, someone that you've worked with for a long time and you trust and they have your best interest.
Yeah.
But that's also something I've seen firsthand where the protector might be from a previous generation, as in when it was set up originally, protector is kind of linked to that person. And then that person is no longer, that generation doesn't exist anymore, comes down to the next generation. Yeah. They maybe don't have the same vision as the protector. That can cause some issues is where I've seen that firsthand. But and then maybe let's just touch on as well the different types of trusts.
Yeah. So, I mean, coming back to, if you appoint yourself as all three, it eradicates essentially the primary reason and the primary benefits of implementing a trust in the first place. And in the UK, we have a discretionary trust and a non-discretionary trust. The difference of that is a discretionary trust is me giving you discretion to manage and control the assets at your discretion, right? So you have full remit and control of those assets. A non-discretionary trust is where I retain discretion as the settlor or as the owner of the assets, which again, because the legal separation of decision making over those assets the line is much more blurred or not as robust on a non-discretionary basis, then the tax benefits and the general benefits, legal separation, limited liability, these sorts of things is limited as well.
Yeah.
So very important distinction. And again, it's just another nuance of which trust are you putting in place, and does it actually tick the box and serve the benefits of what you're trying to achieve.
And I think that's
fundamentally,
that's always the thing, right? Is, and I say this as a user, I always say the word sat nav, but sat nav isn't the word these days because we use Google Maps. We used to, you're probably too young, but we used to use sat nav. But when you go somewhere on Google Maps, you can't navigate without the end goal, right? You need to be able to put in where you're going and to navigate how that journey looks. And it's exactly the same with the kind of structuring and planning. It's like, you need to think about what that exit point is like, because what's an exit point for you versus what's an exit point for me, the timelines, the this, the that, I've got family, you haven't, et cetera, as in kids and stuff. It's a very different potential outcome, and you can't have that end goal. You can't have the journey without the end goal. So I think it's always like, what are we doing and why are we doing it? And then we work back. Here's where we are today. Here's where we want to be. How do we get there? And that map is what tells us how to get there.
And like we said at the start, it'd be great if it's simple, but it's not, unfortunately, which is why we have a job, and it's why clients come to us, because it's our job to say A, B, right, what's the quickest?
Yeah, we're effectively the Google map algorithm in the middle that's saying, you told us A and B, we're telling you how to get there in the middle.
Exactly. And, trust is just one thing. The other thing we've spoken about is foundations, which is a completely different legal structure. A lot of the ultimate objectives and benefits overlap somewhat, but the fact is it's a completely different legal structure and has nuances and, stronger in some cases, weaker in other cases. And obviously foundations is a very big and common tool here used in the UAE in ADGM or DIFC, right? So we do that for a lot of clients here.
Yeah, and I guess the roles are different. You have council members as opposed to, I guess, trustees.
Yeah.
You still have beneficiary on both sides.
Yeah. And then a founder
rather than settler. So there is, like you say, there are different words, but they're similar sort of concepts. In this part of the world, foundations are very strong. We hear a lot of people, and we do a lot of that work. But again, we talked about this earlier. If you're a UK resident, UK tax resident, and you are looking at a vehicle to protect wealth, mitigate tax positions, etc., then there's an argument that a trust is probably better because you've got a legal separation between you and the assets, whereas a foundation doesn't quite deliver that. It doesn't quite deliver it delivers the legal separation in a way that a company delivers a legal separation, but it doesn't deliver a legal separation to the benefit of that, if that makes sense. So I think it depends on you, where you are, what you're doing, where you're located, where you're paying tax, where you're,
But does that not come down to, if you're appointed yourself as the council member, that's the same as you appointing yourself to be a trustee and blurs the line, versus if you're appointing somebody else or your children, for example, as the council members, like that legal separation stands up a lot stronger.
It does stand up a lot stronger, but I think the way that foundations are perceived, and maybe this is kind of historic, the way it's thought about, if that makes sense, rather than the actual fact. But it does feel like, when in the eyes of the law, foundations aren't seen as strong when it comes to that separation like a trust is. It still gives it, and again, like you said, it all depends on the setup and the structure and the plan. But I think it's just the way it's looked upon because of the trusts have been around for so long. Like I just said, I can't remember the exact time, and we'll have to try and find the exact scenario for that. But they've been around for such a long time. They're like, everyone that's growing up now as a lawyer or a tax advisor or whatever in the UK, they know trusts.
Yeah.
They don't know foundations as well. So maybe that's just the same with how jurisdictions are viewing them.
Yeah, for sure. And then we've got holding companies as well, right? And again, a holding company, a foundation are their own independent legal entities. Primary difference is a foundation doesn't have shares and shareholders. It's obviously got founders and council members, whereas a holding company has shares and shareholders, right? But equally, it is a separate legal entity owning your assets rather than you or another individual.
Yeah, exactly. And I think, again, I would argue with the holding company, if we were going down a complete spectrum of clear separation, I think it's trust, foundation, holding company. Holding companies are much simpler to set up.
Mm-hmm.
Most people will have a holding company. A lot of people will have foundation, holdco, opco. As a kind of plan. So they typically sit in the middle of a foundation and the activities underneath. And obviously the holdco, the foundation could hold pretty much the same assets effectively that the holdco, could hold. Sorry. But a lot of people still put that layer in between to kind of give that separation. And also you might want different, your holdco here, you might have some real estate, some crypto, some investment vehicles. And then that goes into holdco, and then you might want that holdco, you might want half of it to go to this foundation, half of it to go to this foundation, whereas if it all goes into a foundation, then it's a bit more tricky to determine distributions. And so I think that's where a holdco sits quite nicely in the middle, is where you can then really kind of route things through, and it becomes a bit more of an operational.
Yeah, it's another controlling vehicle, right? They're typically significantly cheaper to set up, much more simple, which means you can have the complexity of a foundation or a trust being at the top of your structure, and then you can have a bunch of holding companies, and again, you can dissolve them, you can set up new ones, different,
and they're much more widely available. Like you can get them in the UK, you can get them in UAE, you can get them in BVI, you can get them in Singapore. So they're much more widely available.
Absolutely. So there you go. Essentially, 3 very, very effective wealth planning vehicles, all with their nuances, and typically 9 times out of 10, when we implement any of these structures, we're implementing realistically 2 of the 3.
Yeah.
2 of the 3, or if not, maybe we'll have a complementary foundation and then a trust to look after Western and UK assets, and a foundation to look after Middle East business interests and Middle East property, because it's very effective at doing that. But holding companies generally sit underneath in all scenarios.
Yeah, and I just wanted to touch on costs as well. Typically a foundation is quite significantly cheaper than a trust.
Yeah.
So again, if you're looking, not just anyone that's looking at this sort of structure and planning and they're only looking at the cost is in it for the wrong reason, because that's not, you need the right solution, not not the cheapest. But if you are kind of considering between the two and both give you an element of what you want, a foundation can be significantly cheaper, or could be a foundation starting point and then a trust later or something like that. So that's the other point. I want to give, if we can, maybe an example of kind of each scenario, right? So maybe you could give an example. We're working with a client at the moment. We're supporting them on a kind of foundational holding company structure. Maybe you could just talk through that.
Yeah, absolutely. So this is essentially a client who's very successful, built and founded a successful business, owns the shares himself personally. And at the moment, he's in the middle of a fundraising round. So at the moment, we're working on, before the valuation of his company explodes through the valuation that's triggered by the fundraising round, we want to shift the shares, which, as I said, he holds personally, into a more robust and a better long-term structure for him, right? And ultimately, what that structure that we've set up looks like is to set up a foundation in ADEGM offshore, because he's not based here in the Middle East. And then he'll transfer the ownership of the shares, which currently have little to no value, into the foundation. The foundation is then going to hold and own his company shares. And then when he goes through his fundraising, and actually he will receive proceeds off the back of that, all of that money will stay within that structure that we've implemented, which is the foundation. So it'll all sit offshore, out of his personal balance sheet, out of his personal name, which comes with massive tax benefits for himself personally. And then underneath that, of course, we're setting up a private bank account based in Switzerland. We'll take care of the asset management side of things, but ultimately it gives him a really robust and secure wealth planning vehicle for his existing business ventures, fundraising, his investments, and then future business ventures as well, all within this one really nice, neat structure.
I think it's really interesting because with that one, a lot of what we're doing is kind of pre-work, right? It's he's going to be successful. They're going to go through a very decent sized funding round as we speak. He's also messaged me this week actually and said that he's taking shares in another entity, so he's going to put that through the foundation, which is great. So he's already thinking like, how can I value? So for him, he's at an earlier stage, if you like. So we're trying to do a lot of pre-work before, but there's also the option of you have got an amazing bit. We've got one, I think it's a restaurant chain. And we're then putting in place a kind of structure above that, holdcos, foundations, etc. So they've already built a chain of very successful businesses, and we're putting the structure in retrospectively. So that's possible, but it's also possible to say, do you know what? Let's plan do it before if we can, and be ready. So I just wanted to
absolutely, and I think that's the key, right? Is if you're in a taxable jurisdiction, you will 9 times out of 10 save yourself a lot of unnecessary tax, and it's easier to implement these things ahead of time rather than one, face a tax bill that you don't want to face when you are taking huge dividend distributions or payments from a company, but 2, then also to unwind once the value of the shares of his company has exploded, to then transfer that. There's potentially a taxable event on the transfer because it's a disposal of assets, and the tax man typically comes knocking as well. So it's important. I'd say you always engage a professional as early as possible. Even if you have a conversation today and then you don't do anything for 3 years, it's still incredibly beneficial to have had that conversation earlier rather than later.
100%. And then the example I would give on the trust side is we've got a family office client, multi-generational business asset classes that have been generated and whatnot. Fairly significant income level going into the trust, assets based all over the world, and that is a very much a multi-generational wealth planning tool. Here to the next gen, to the next gen, to the next gen. And when the beneficiaries and different members of the family office are based all around the world in different taxable jurisdictions, in different situations. They've also got their own lives. Some of them have got their own businesses doing their own thing. It just gives a lot more control to the family's assets to say, this is the family's assets managed by the trustees, professional trustees that can, help build And the family now as well, they're quite happy to be more passive. They've made a significant asset base, which is yielding them a significant return year on year. So they can be a bit more passive now. So they can allow the trustees to really manage the asset base because they've built it to that point. Whereas I think if you are still building businesses and grinding, you probably want a little bit more control, and maybe the trustees aren't as simple as that from a control perspective. So I thought that was a good example, multi-generational family, high net worth, kind of structural setup with a bit more passive income versus a younger guy that we talked about in terms of the foundation and growth potential, structuring that, and then also somebody that's got a business, a multi-site business, lots of different things going on, and structuring that as well. So 3 kind of different but similar examples of wealth planning.
Exactly. Perfect.
Cool. As always, hit the like button, hit the subscribe button. You know where we are if you want to get hold of us. And see you on the next one.